next guest says that the highs are not in yet for Treasury yields. I'm going to bring in MonetaryMacro.com CIO Joseph Wang. Joseph, does this mean that the Fed also continues to hike rates?
Hey, Charles, thanks for having me. I believe so. That's actually what I took from Powell's speech today. As Danielle DiMartino Booth mentioned, the speech sounded really much like what he was saying before. But what really struck out to me was that he mentioned, commenting on the economy, is that if the economy continues to stay strong and it looks like growth is above trend, looks like it's accelerating, looks like consumer spending is strong, that they might have to hike rates again. So I think the Fed isn't done yet. And you can see that being priced into the markets today as well. So if you look at what the Fed is looking at, so the Fed thinks GDP growth is 1.8% as trend growth. In the first quarter, we grew at 2%, second quarter, 2.4%, and the third quarter, the Atlanta Fed Now GDP nowcast, which is going to be revised, is showing a bonkers 5%.
Right.
So it looks like growth is accelerating. So if that's the case, the Fed has to hike, or else, like Chair Powell mentioned today, inflation might come back.
Yeah, I think bonkers might be the right word for that. So Powell is also pretty firm on this 2% inflation target, pushing back against these rumblings. You know, a lot of folks are saying 3%, some saying even higher. If they're going to be higher for longer, I mean, is it a moot point anyway?
Well, I think Powell did the right thing by firmly pushing back against the inflation target. But what you have to keep in mind is that the Fed is independent within the federal government, but not of it. So all these influential voices that we're seeing, people like Jason Furman, who is a very respected economist, and also others, they are trying to push the dialogue towards socializing a higher inflation target. And so that might eventually feed into the Fed, not immediately, and maybe not with this Fed chair, but maybe in the coming years. So if you're a bond investor, that's something that you might want to keep in mind before you buy something like a 10-year or a 30-year Treasury. You
know, that's a great point. I look at the political makeup of the folks at the Fed, and depending on who wins the White House next and who the next Fed chair could be, there are going to be some things that happen there that we never thought could happen before. You just kind of alluded to that. So a lot of smart people I know for the last couple of weeks have come on this show and said, I'm loading up on bonds. They actually tell me it's a foolproof play, is it?
So you're exactly right. From my read of the data, the asset management community is definitely very bullish on bonds. And if you think the future looks like the past, it's a good bet, right? So we have a recession, Fed cuts rates, bonds go up in price, you make out like a bandit. But I actually am not looking at it that way. I think that the future will not look like the past. And so I think these people are going to be wrong-footed. I think the bond market, bull market is over, and we're going to have a decade of rising rates. There's two ways I look at this. One is just looking at the supply of bonds. If you look at what the Treasury is forecasting, we're going to have $1.5 to $2 trillion in issuance every year, basically forever. Now, if you like bonds, that's great, because you're going to have more than you ever wanted. But that also means that bond prices are going to have to come down. And secondly, like we were discussing, the politics is changing. In our culture, I think if we have to choose between higher inflation or higher unemployment, people are going to be willing to tolerate higher inflation in order to keep their job. I think that's where the culture is going. And so if you are buying your bond, I would be worried, because maybe the inflation target does change because the politics and the culture change.
You're making some amazing points here, Joe. I've got 30 seconds, and just having said all of that, no one's talking recession anymore. Have we taken our eye off the ball there?
So I actually think, I was not thinking we'd have a recession this year, but I'm beginning to think we'll have one next year. The reason is because these longer dated yields, they're finally going up. So when the Fed is hiking rates, they're hiking the overnight rate, but really that doesn't matter. Nobody borrows at the overnight tenor. Where people borrow at is, let's say the 10-year yield, right? And that was range bound for most of this year, but now it's breaking out to the upside. So I think that it's going to tighten financial conditions enough such that we can have a recession next year, maybe in the second half of next year, but not this year. And right now, things look pretty strong to me.
All right. That feeds into my last segment. Live life while you can. Bread and circus is for everyone while it lasts. Great stuff, Joe. Appreciate it.